think we're all quite impressed in your ability to decipher like the quality of policy. The one thing that you mentioned about like 5 minutes ago, and then we talked about before the call, is the other factor that's going to drive the returns here, which is like the Federal Reserve. So if we could, can we turn this conversation a little bit to your thoughts on the Fed balance sheet, the TPG? I know you guys as a firm do a lot of work in this space, and it relates to how you make your investments in this space as well. So if you could just maybe paint your framework picture for where we are in the balance sheet, and if you want to give us all the billion-dollar question of like, where is it going in 12 to 18 months? So.
Awesome question. So first, let me say my bias is that I believe that stimulus matters for equity markets and for bond markets. My clients who are bottom-up stock pickers tell me I might overestimate the impact that this has, and that's true. There's definitely fundamental factors, but there's also macro factors. That's why I work at a macro firm. And since 2009, since we started a quantitative easing period, there's been a very strong correlation between the price to earnings ratio on the S&P 500 and the level of what we call liquidity in the system. Liquidity is the Fed balance sheet, the TGA, which is the Treasury General Account, and reverse repos. Those last two, the Treasury General Account, reverse repos, are relatively new concepts that started in 2020 and late 2021. So really, it's the Fed balance sheet that was the main driver of that. And that makes sense. The Fed is basically lowering interest rates, changing the discount that you're going to put on earnings, and it changes the allocation that we want to buy in stocks when they're in QE period. What happened is that in 2020, the Treasury Department made a decision that they were going to fill up what's called the Treasury General Account. This is a fund that usually held less than $1 billion, maybe $5 billion at most. And what they did in that fund is that they basically built it to about 450 billion. And so they said, okay, when we get to an emergency, we'll have this fund to spend so we don't have to go to the bond market. And that emergency would be like 2008, 2020, and that they'll have that. Well, it had some unintended consequences, because when we hit the debt ceiling, the Treasury can no longer issue net new debt. And they said, oh, well, we got this wonderful Treasury General Account that we could spend down. So the Treasury, since January 19th, was basically spending $600 billion out of this fund without raising debt or raising taxes, and it was offsetting the Federal Reserve's quantitative tightening. Imagine on January 19th, if the Fed chairman stood up, did a press conference and said, I'm canceling QT from now until June 2nd. The market would have went bananas, and the 7 or 8 big large cap tech stocks would have went totally crazy. Okay, but we just did it through a back door. And the reason why I bring that up to you is we learned in 2021 that when we raised the debt ceiling, we had this massive rally in stocks. And 17 days after the debt ceiling was raised and Biden went to market and started issuing debt, the S&P rolled over. The NASDAQ began to underperform the S&P 500. You began to see this rotation in stocks. And so, again, we learned from that. We learned that this stuff really matters. And that relationship between net liquidity and the S&P, or net liquidity and NASDAQ relative to the S&P, or the dollar, or Dan, don't get mad at me, Bitcoin. Bitcoin fits perfect with our net liquidity index. Okay, like it's amazing how all this stuff was just working. So we just went through a debt ceiling. We just raised the debt ceiling, and our view was that once the debt ceiling gets raised, you'll start to see more risk into the equity market, and particularly around a sector rotation away from the high-flying tech, more into industrials. And by the way, that the rotation into industrials is happening. But man, the tech stuff just doesn't stop, man. It's relentless, and it's probably going to go on for a little bit here. But we are draining so much liquidity. We've done 250 billion in the last 2 weeks. And what will happen is that money will start to come out of bank deposits to fund the debt, and then it will ultimately come out of bank reserves. And as it goes out of bank reserves, that's where you'll start to see the equity market response. Now, what we do is we try and match up all these indicators with liquidity. And one that did not work was something called gold. And that was a surprise. What we found is that gold is a leading indicator of liquidity, and gold is telling you where things are headed. So gold led the markets on inflation on the way up. Gold led the markets on inflation on the way down. And gold is telling us that liquidity is going to come down until November. And once we get to November, we're probably going to see a big shoot up of liquidity. And that makes sense to us. The economy is probably going to start slowing here. Employment's going to start slowing here. The Fed's going to be under pressure to start relaxing some of its QT. And boy, does Joe Biden want to get reelected. And they're going to have $600 billion in their TGA. There, right? And you're going to see this pump get primed. And I think actual liquidity is going to be higher in 18 months from where we are right now. But you have to go through this lower period, probably for the next 3 or 4 months, before you begin to see it reverse.